And then I'll make you host. Yeah, if you want to get started.
Okay.
Steve's on, Elena's on.
Let's see. So can you see that okay?
Yes.
Awesome. Okay. Well, we'll go ahead and get started if that works for you.
Okay.
Fabulous. Well, hey, everyone. My name is Christy Botain. I am a commercial loan officer with Meadows Bank. I've been in banking and finance for 30 years, the entire time working with small business owners, and have had a greater opportunity moving here to Arizona in 2016 and getting a little bit more involved in investment real estate properties. So I appreciate Mara with Bliss Realty inviting me here this morning to chat a little bit more about that, certainly from a lender's perspective. So again, some of this is going to be straightforward, simple, and I just hope to share some insights with you about what it looks like on my side of the desk. So of course, our investment properties, these are generally the ones that I get the most exposure to in various formats across the valley. Mara, out of curiosity, what do some of your agents work with? Are there any niches, or is it more universal in these varieties of properties?
We allow universal. I think that's one of my pet peeves with actual commercial brokerages is they'll pigeon toe those agents in a certain specific area. And I feel like there's a lot of opportunity lost, especially when you're networking or meeting or your database is growing. Um, I think
Yeah,
even if you haven't done it, you should learn.
yeah. And there's something unique about all of them. And so lending and working with individuals on this side is a bit different compared to the other side for me, which would be just an owner-occupied facility. There's some similarities in the underwriting, but there's quite a few differences, and I'm sure the same is from your agent's perspectives. So there's really two metrics that I would look to underwrite an investment property with, and that's going to be our straightforward loan to value or loan to cost, as well as the debt service coverage ratio. So where I usually begin in my conversations with individuals is we're looking at that loan to value, loan to cost. The lender is going to take the more conservative approach, so it's always going to be the lesser of the two. So if we're dealing with a construction project or an acquisition project, we're going to take the lesser of those two values. I generally start at 70% loan to value and we'll go down from there. I would say over the last 12 plus months, 12 to 18 months, I've been seeing those come across my desk closer to 50%. Loan to value, loan to cost, which is quite a big chunk for investors to come up with. When economies are strong and there isn't a lot of uncertainty, that's where we can hit those higher loan to values, along with the risk associated to the property. And with investment real estate, that risk is going to vary on so many different metrics, which I'll get into a little bit later in the presentation. And so on the flip side, it's really about the cash flow for the property and where that debt service coverage ratio is going to come into play. I know there's nuances, as I mentioned, with construction real estate versus an already stabilized property. And so there's going to be some different debt service coverage ratio metrics related to a construction project. For like just ramping up, filling in the space, et cetera, versus an already stabilized project. I'm going to want to see that at 1.25 or higher. The higher, the better. So I just want to pause on those two metrics from a lender's perspective on what we look at, see if there's any questions. Hearing none, I will move on. And so from an underwriting and risk assessment perspective, I'm going to underwrite a few different things. So I'm going to underwrite based on the borrower's creditworthiness. If they've had prior real estate investment, that's of course a plus. I'm going to look to the borrower's financial history, whether that's the borrower itself or the guarantors. It does come up a fair amount of time that an investment project will be considered on a non-recourse basis, which wouldn't involve guarantors. I'm actually working on one right now that is non-recourse, non-guaranteed by individual owners. I'm going to dive into that a little bit deeper in a few more slides. We're also going to take a look at the property itself and the analysis of its location, its condition, the tenant mix, the lease terms of those tenants, certainly the localized market trends on that type of property, as well as the overall market risk associated. So taking into account our local market demands, vacancy rates, economic trends. So there is a little bit more involved on investment real estate underwriting compared to, as I mentioned before, owner-occupied underwriting. And so some of the challenge that present in those is certainly based on our real estate cyclicality, downturns in the property values. The project that I'm working on right now is approximately 17% vacancy, whereas the market is more normalized at about 7% vacancy. That is a retail project versus an office project, industrial, hospitality, et cetera. So we take those into consideration in underwriting projects as well, just the various market fluctuations that are happening at the time, anything that might be coming down the road, pending recession, which I feel like we've been talking about forever. You think about the volatility as it relates to our current election cycle. I don't know for sure if the kind of hold tight and see what happens mentality that I've been seeing over the last few months is related specifically to that, but I can't say that it might not be either. So we're going to take all of that into account in our underwriting. So here, this is just kind of a general idea on things that we consider with regard to the vacancy rates, whether the property is multi-tenant or single tenant, whether those tenants are national tenants like a Starbucks or the mom and pop grocery store, bargain outlet type of business. We're also going to take a look at the lease terms. A really important factor when looking at investment real estate is those lease terms as it relates to the term of the loan. More often than not, most loans that I see are done on a 10-year loan term. The rate, of course, is going to reset at the 5-year mark or the end of the 5-year period. And then I do have to consider if the tenant's lease is up for renewal or maybe even expired during that time frame without the option to renew, there's inherently higher risk to that. So it's really important for me to understand the buyer's plan on what they intend to do with that property, what types of tenants they're going to look for, and take that into consideration. So there is a lot of understanding as it relates to the lease terms on an investment real estate deal. I already touched on the debt service coverage, of course, the age and condition of the property, if there's any deferred maintenance, taking a look at the historical aspects of the financial performance for the property, along with the projected performance that the new buyer will put in place. That's all taken into consideration and underwritten as well. And so these are just general ideas. Like, so say, for example, there's an office property in downtown Phoenix. Looking at a 70% loan to value today is probably going to be considered a little bit higher of a threshold. I'm going to want to see pretty strong tenant occupancy, longevity, lease terms. The debt service coverage ratio of 125 on that type of property is also going to be considered pretty slim. So as compared to, let's say, for instance, a retail property in Mesa that's looking to be at 65% loan to value with a little bit higher debt service coverage. So even these small tweaks in the equity position, the loan to value, as well as the debt service coverage ratio really can impact the risk associated to the property. Medical office in Chandler, for example, at 50% loan to value, that's going to be a pretty good position to be in right now, especially with a much higher debt service coverage. So that third one on the list is going to be looked at a little bit more favorably because it has a lower loan to value threshold and a higher debt service coverage. And then just a couple of other examples. I have seen projects come across my desk where the loan to value is 30%. Good, strong debt service coverage. That's a far easier one to get done than would be, say, for example, the downtown Phoenix office, one that's at the top of that list. So I'm going to pause again and see if there's any questions just in general about what I've talked about so far. Okay. Hearing none, I will move on to what it looks like from the purchase agreement to loan closing. Again, this is from my perspective. So when I get presented with an opportunity, sometimes there's a purchase agreement in place already and sometimes there's not, but it's certainly almost getting penned out. I'm going to issue a term sheet. That's going to be the general terms and conditions. It's going to talk about the loan to value. It's going to talk about the interest rate, any special conditions that might be present based on the property. And so if the term sheet is accepted, I'm going to go into a little bit more deeper understanding of the financial information on the property, the rent roll, certainly like I mentioned before, the analysis of the borrower and guarantors, the cash flow. Also, at the time that the term sheet is engaged, we don't have a formal approval at that stage, but we have a general idea that this looks to be a pretty strong positive outcome. So at that point, we're also going to engage the appraisal. If there's any environmental reports, like a phase 1 report that might be required, we're going to get that rolling as well. And so going through the underwriting process, generally speaking, that can be from anywhere from 2 to 4 weeks, depending on the complexity of the property, depending on the timeline of getting the appraisal back, and some other factors that come into play. So then once a credit is approved, I'll issue a commitment letter at that point. That's a conditional commitment. Really, there's just some additional closing conditions. For example, preliminary title work that might not have been completed, as well as any other conditions that we might need. That timeline can range from anywhere, again, from 2 to 4 weeks to completion. Generally speaking, start to finish, from the time that a term sheet is signed and or a purchase agreement is penned, the timeline can be 60 days to 90 days. I know that there's financial institutions out in the market that might be able to do it much faster, some that take quite a bit longer. And then I'll also mention SBA lending. That's in its own space and how they proceed and the timelines that they work with. So again, just a general understanding of what it looks like from purchase agreement to loan closing. And I mentioned before that I'm working on an investment real estate project that I wanted to touch on. It is a retail center in Mesa, and there are 2 pad sites, as well as, I believe, 15 tenant spaces. I mentioned before that it's currently at 17% vacancy. So the term sheet on that was issued September 19th. We were able to get the appraisal engaged on October 7th and is currently in the underwriting phase. And what I've been working on in that underwriting phase is reviewing all of the lease agreements, all of the amendments to the leases to really understand the history of those tenants and what that tenant occupancy will look like for the next 5 to 10 years. That project was initially outlined on the term sheet to have a 10-year maturity based on a standard 25-year amortization. And so it does take a fair amount of time to go through. I think I'm going through about 12 leases, maybe 10 or 12 leases on that property. And having gotten the appraisal ordered on October 7th, I should be expecting that back here in the next week or so. And so that will be a lot of helpful information because it's another third party that's reviewing that lease information, as well as the income producing potential for that property. It would be considered a B type property. So it's older. I believe it was built in the 80s. I think it might have been remodeled. Actually, one of the pads was remodeled. So the property itself has just been under just regular maintenance since the 80s. And so it's a little bit more of a tired property. But I know, having talked to the owners, that they're looking at a new marketing plan for it. They're looking at getting some new tenants into the space, certainly filling up on that vacancy that they have available to re-energize the property. And so taking a look at the historical financial information and trying to compare that to the projected financial information, making certain assumptions about what the current owner has done, what the proposed owner will do, and coming to a general idea of what that cash flow will potentially look like. A couple of challenges that I've encountered on it is some of those leases, probably about half of those leases are up for maturity, and there actually isn't a renewal option on those leases. And so I've understood from the current the proposed owner what their plans are to utilize that. What that could potentially mean from an underwriting perspective is that we might be ending up asking the proposed owner to put some funds into reserves to have on hand, whether it's 6 months or maybe even 12 months of reserves to cover the releasing timeframes where the tenants might not be occupying that space. So again, just wanted to describe the general process there. The current purchase agreement references a closing date of December 6th. Right now, as it relates to the timeline, we're still on track for that. I do suspect that over the next 2 weeks, depending on more information from an underwriting perspective, if that comes in, we might elongate that a little bit further. But that just gives you an idea. So the term sheet was signed on September 19th. A potential closing date of December 6th gives you that general idea of the timeline for this multi-tenant retail investment project in Mesa. So with that, that kind of concludes what I wanted to share with everyone this morning, and would certainly open it up to additional questions.
What kind of rates do you usually have on these big commercial projects? I mean, a variance.
Yeah. That's a great question,
Is
Steve.
there
I
a
know I didn't touch
high
on
or a
that.
low? Obviously, I
Yeah.
know loan to value and all that stuff is gonna play a part in that, but I mean, what is my
So
worst case and best case?
yeah, so a really good range to work with for the most part is the 5-year treasury. So unfortunately, the 5-year treasury for the last, I'm going to say 6-ish weeks has been on the upward trend. So this morning I just checked, it's at 4.12 right now. Normally I'm starting with a rate of the 5-year treasury plus 300 basis points. So that puts us in the low 7s right now. 60 days ago, we were, I think it was right around 3.5%. So I was seeing the mid-6 percentage for projects at that time. So that's a good guideline, is using the 5-year treasury rate. Certainly the lower loan to value, the higher debt service coverage on those properties will allow for a lender to decrease that by 25 basis points, 50 basis points. So generally speaking, right now, we're probably going to be in that 6.75 to 7.25 right now. But the interest rates over the last 12 months have been relatively volatile in that space. But let's keep our fingers crossed that we continue to see that go down, in this current short-term trend of that 5-year treasury starts turning the other way. I will add, Steve, that if we're dealing with a construction project, that construction interest rate is usually going to be based on prime plus a certain spread. That spread could be 0. It could be 1, but the construction period is going to be a variable interest rate. It's going to be an interest-only repayment. Usually that's going to be in the form of reserves already established in the project.
Is that usually 2 years construction time?
So most of the time, conservatively speaking, we try to stick as close to 12 months with the option to renew for an additional 6 months. So getting us to an initial approval to include an 18-month period, but it really depends on the project. So a good lender is going to understand that project timeline and build in at least some form of a cushion for an extension up to potentially 24 months. That's generally where those come in. Does that give you a good idea?
Most of these loans are 10-year maturity on a 25-year amortization.
Yep. It would depend too if the what the strategy is for the investor. Is the strategy meant to be short term? Is it meant to be long term? If it's short term, the lender might choose to do a 2 or 3 year fixed rate, maybe even a 5-year term. But more often than not, most of those projects are hold right now. So we're going to see more of the 10-year term and the interest rate reset at 5 years. So another thing I want to mention is it's been a big part of our conversations on the lending side of the table over the last 12 plus months about deposits. So a lot of the time, whether I'm getting contacted by a potential buyer or even a broker, is understanding that the bank is likely going to tie having a deposit balance associated with that loan. And it's going to be more than just having the operating account for the property. It's usually going to look like 5% of the commitment amount, even up to 10%. Most of my investment properties require a deposit covenant that's 10% of the loan commitment. So that's been a big part of our conversations, especially over the last 12 months.
Sorry, could you touch base on this is Kunal, what would be the typical down payment for a commercial property?
Yeah, so most of the time when economies are good, everything's strong, most investment properties are going to be looking at 30% down right now. And it's been going on for, again, the last 12 plus months. We're getting closer to 60% loan to value, meaning 40% down, even upwards of 50% down. The project that I described that I'm working on in Mesa, that was proposed at the lesser of 50% loan to value, loan to cost. I will add on that particular project, the appraisal, I actually did just get that back on Thursday, and it came in higher than the purchase price. But again, as a lender, we're going to take the lesser of the purchase price or appraised value and base our loan amount off of that. So that one's at 50%.
Thank you. Yeah, I had a client who was interested in a franchise, like a Dollar General. Um, but I think their mindset was after a few years of operation, they wanted to rebrand it to something else. Now, in that case, would you would you redo the loan at the time of refranchising, or?
Yeah, that's a great example. And so I would only make an assumption in that space that maybe the lease term for Dollar General was going to mature in that time frame, therefore
Yes.
allowing the owner to bring in somebody new. I think it would be a part of the underwriting to really understand what that looks like. It hasn't happened to me, so I don't have a lot of basis to go off of how I would underwrite that initially, or if I would require re-underwriting. Most of the time, what comes to mind is that the bank would be a part of the conversations with the new owner in who they're looking at bringing on board, and taking into account underwriting it, not necessarily revising the terms, but in essence, giving approval for that new proposed tenant that they would be looking at.
Got you.
So yeah, a really great factor is just making sure that, you know, the banking relationship is a strong one. That is not just the transaction itself, that there's open communication and dialogue on an ongoing basis, so that if any issues or challenges arise on the property, that the bank is informed, that the owner is talking to their lender about their plans way in advance versus having surprises pop up.
Yeah. Now, in that case, do you also look at the cap rate for that property
So
and
although
then
the cap rate is a part of the underwriting, certainly associated to the appraisal, et cetera, from my perspective as a lender, it isn't a heavy reliance. It is a consideration to make sure that the cap rate is within a general reasonable range. For
okay,
as long as I've been doing this, I can say that it's come up extremely rarely where that cap rate has just been so out of whack or didn't make sense. But from an underwriting perspective, for the most part, you know, it's in a reasonable range. It's just not something that we pay a strong attention to in most cases.
got you. Yeah, so I think they were looking at the loan right now being close to 7s and 8. But I think I heard you say in the low 6 or high 6s right now.
Yeah. Yeah.
But they might be in a consideration of, yeah. Okay, appreciate it. Thank you.
Yeah, absolutely.
Hi, you mentioned having reserves for leases that were, for tenants that were going to be coming at maturity and having reserves for them. Now, my question is, do you base those reserves on if the if the customer has more tenants lined up, and do you associate those, like the names of those tenants, as far as their reserves, or is it you base the reserves on just outgoing tenants and no potential for renewal?
Yeah, that's a great question as well. There isn't necessarily any hard and fast rules. Every single property is completely unique, and the things that you touched on, whether there were known potential tenants early in the conversation or not, and what's taken into consideration. Generally speaking, we're going to look to a period of time for coverage of principal and interest payments. That period of time can be 6 months, 12 months. It could potentially be longer, but for the most part, I'm seeing most reserves on projects be in that 6 to 12 month timeframe of having principal and interest payments, funded into a bank control account.
Thank you.
Yeah. Really great questions from your team, Mara.
No, this is great. Do you, what are you hearing from appraisers? I know this market is not as busy, but as we get through the election, depending on for next year, what are they projecting? Appraisals still coming in at value? Are they having issues? What are you guys hearing? Anything?
Yeah, a good question there too. Man, I hate to say, but it seems like in our world of banking and finance and all that we're talking about today, as time goes by, it seems like things continue to be really interesting. I use that word so much. It's like it's somewhat unpredictable. And this year in particular, I would say that from a lending perspective in commercial real estate, we went through a period last year where we started to see that things were just not penciling out. The increase in interest rates was just moving projects off the table. It just wasn't cost effective. And so what that's transferred into for 2024 is a little bit lighter space for deals in general. And so to talk about what commercial appraisers have been seeing or what they anticipate seeing, there's far less discussion just because there's been less volume. And so I know earlier in the year, I was working on a project that had a single national tenant over in Maricopa. And, the timeline for appraisals, they had that turned around probably in 2, max 3 weeks. Whereas in prior years, 2023 and earlier, commercial appraisals were taking 4 weeks, sometimes longer. And so just the volume has decreased. And right now, what I've observed, even in that limited volume, is it seems like the values are coming in at or higher. And so maybe to make a completed circle here for you, Mara, is I'm not hearing much feedback from appraisers on what they're anticipating going into 2025. And I'm hopeful that we will, the wheel will start turning a little bit faster, especially this quarter, in getting some more deals booked and completed so that we have a better idea of what 2025 might look like from the appraiser's perspective.
Well, and I think that's a really good point. If you're bouncing from residential to commercial, it's the time frame on the appraisals. That's a really big one. And I'm wondering if the appraised values coming in higher because of the negotiations are coming in lower. So will that affect values for next year is something we probably need to keep an eye on,
Yeah, and the one I'm working on actually came in quite a bit higher. We're still working on the review of that to make sure that the assumptions are reasonable and appropriate. So, even in that space, we have an external appraiser complete the appraisal report. It's actually reviewed by the third party we work with, but we also review it as well. So there's a lot of eyes on an appraisal report from the lender's perspective to really understand what the assumptions are and kind of what's happening. I was a bit surprised that it came in so much higher in that value. So it will be interesting to see kind of what's happening in the next 3 to 6 months and longer with those values.
True. So just a quick question. You may have already answered it. If you're giving a business a loan, what is kind of your process if they're leasing a property to put their business in and then they go to you for a loan? Is that possible? And then what do you guys, I know there's a business plan in place. What do you guys take into account to loan out, or is that not you? It should be a small business loan, or what are some of the processes? What does that look like?
Yeah, I apologize, Mara. I must have an unstable internet connection. I'm gonna hate to ask you, but could
Oh,
you
you're
repeat
fine.
that?
So let's just say, like Kunal was talking about, you have a business owner and they're wanting to lease space, but they're also taking out a business loan to get their business going. So what does that look like for you? There would not be an appraisal involved, correct? But you're doing an evaluation on how successful this business is going to be. They have to have a business plan, right? Would they still be looking at the 6%? How does that look for you?
Yeah, so maybe if I understand correctly, it's not, they're not purchasing the real estate, but
Correct.
what does the underwriting kind of look like
Yeah.
and what is taken into account? So yes, in that particular case, we're certainly gonna, if it's an existing business, we're gonna look at this historical financial information. If it's a startup, that's gonna be the projections based and what assumptions they have in those projections, and are they appropriate assumptions? So we're going to take a look at more heavily that financial performance, whether it's in the past or whether it's in the future, about the ability for that business owner to repay a loan. I'll also mention, of course, if they're a startup, SBA is going to be the way to go. Conventional lending, I'm looking at a minimum of 2 years of operating history to be able to see if a business would qualify for a conventional loan. By conventional, I'm just talking about the straightforward term loan, line of credit, something of that nature. And so really what I try to do is have that conversation with a business owner about where they've been, where they are, and where they're going, to determine what is the best fit for you. What does it look like from a conventional loan structure or an SBA loan structure? What's going to work best for you based on what your goals are in the short term as well as the long term, and taking that all into consideration to determine the best path for that business owner to take. Is that
Yeah. Yeah. Do you also review the lease? So would they sign the lease beforehand, or is this a handship, like you're doing it all kind of combined?
Yeah, so sometimes it comes up where I will want to see that lease agreement, and definitely will come up as it relates to an SBA loan, as well as an understanding for whether we would need to have an SNDA signed in order to have access to our collateral. So even though the small business might not have a ton of collateral, their business assets in general become that, whether it's a conventional loan or an SBA loan. And so we will take a look at that lease to determine what those terms are. It's a verification source for us as it relates to their financial performance, again, whether it's historical or projected.
Mm. Awesome. Do you guys have any questions? Think of any scenario.
So I'm assuming now that you do business loans, like SBA loans. Is that kind of the same loan to value of those starting at 70%?
So yeah, that will depend on the collateral primarily. For example, if I'm underwriting a line of credit for a business, I'm really going to look at their accounts receivable as the source of repayment for those. If it's an equipment loan, generally speaking, most banks might go up to 100% of the purchase price if it's new, 80% if it's used. If we're dealing with the accounts receivable, we're going to consider what's eligible accounts receivable. We're going to take some of that off, whether it's accounts receivable that's greater than 90 days past due. So we're going to come up with the value of the eligible receivables, and we're going to even discount that further, usually at 75%. If we're dealing with inventory, that's going to be in a range of 30% to 50%. So if you think about the bank and you think about the bank taking the collateral, we're always going to be the conservative. So we're going to discount the value, whether we can verify that value or not. We're going to discount that based on certain percentages. There's actually regulatory percentages that are required. Most banks are slightly more conservative than the regulatory percentages, but I hope that gives you a general idea if we're looking at business assets, specifically those 3 areas that we're going to have a discounted rate.
I went through an SBA loan before. I wasn't very pleasant. I probably would not want to do that again.
They are not pleasant, and it is painful to hear how unpleasant they are. What I try to do with my customers, even though I'm not the primary lender doing the SBA loan, whether it's with Meadows Bank or it's with another party, I'm really trying hard to stay in communication with that business owner so they know what's going on. I know that communication is probably the biggest factor in those being so challenging. Is the business owner, doesn't know where they're at in the process. They don't know if the lender is waiting for information or if they should be doing something. And so it's just really important for me to make sure the business owner understands what's going on and just be that partner walking alongside of them in the process. But yes, it is a very painful process. And hopefully the lender that's working with the business owner can make determinations up front if the path is going to be a successful outcome or not early on, versus spending 3 to 6 months and then finding out that it's not approved. I mean, I've heard those stories as well.
I had a question, Christy. So if they want to get, if they want to lease a space and they want to get a loan first, either SBA or conventional, they don't have a lease yet, but they're looking for a space, will they be able to do that? Will they be able to get the loan first and then finding the space?
Yeah, so what I would say is that depends. And I would also add sometimes. So it's just really important to have the business owner understand what's required, what the lender would require. And I would say in that example, there's a couple of things that come to mind. From a preliminary perspective, the lender should be able to say, based on what you're looking at, even though you haven't found the space, this is what you would qualify for, knowing that they haven't gone through the formal underwriting. So it's not a commitment. It's a preliminary idea. It's not even a preliminary approval. And that's a unique aspect between what I would consider residential lending versus commercial lending, regardless of real estate or not. Is on the commercial side, you can get a preliminary idea, but it's not a commitment. It's not a full-fledged approval. And so I would hope that would help the business owner as they continue to navigate that lease searching space, the property searching space. Then if it came down to the point where really that was the only aspect that was pending, I think that sometimes a financial institution could say, hey, we've got you approved for this amount. A condition to close is for you to have a lease in place. And the bank will certainly want to review that lease, review drafts of that lease, give their final approval of that lease. But I've seen that a part of the process as well.
Okay, thank you.
Christy,
Yeah.
we're looking at getting approved so that our agents can sell businesses without real estate attached. So that's selling the actual business. So that, are you able to do those type of loans? And then, I guess it would be kind of that similar situation where they have to find a place, or do they assume that lease that the previous business owner had? And you guys would definitely need to see those terms, correct?
Yeah, absolutely. And so, yeah, when you talk about being able to work with people on buying businesses, or even on the side of both selling and buying, is if financing is needed, and if a bank is the right solution, yeah, they would want to know those terms, and the sooner you know, the better. But again, it's not a hard line that if you have a general idea of what you're looking for, that there can't be kind of a back and forth understanding of what might be feasible for the bank to provide financing. But I think it's really important to understand what is being communicated. Is this a preliminary idea? I want to make sure that, you know, as business owners, it's not, if you get preliminary term sheet, that does not mean that it's approved. A commitment letter is really the stage that something is conditionally approved. And when I say conditionally approved, there's some things, for example, a lease that's enacted as a closing condition. So yeah, I have those conversations as well.
Do you see that receiving loans nowadays are harder compared to it used to be a year ago because of the way the market is and economy?
Yeah, absolutely. It's I hate to say it, but banking just continues to get harder and harder, and the gap continues to grow in business owners qualifying for, and that is a factor of many things, one of which is our economic state, and kind of where things have been over the last 12 months. It was with the Silicon Valley Bank issue, March of 23, that kind of threw a wrench into banking and finance, that shifted things quite a bit, let alone other variables that were already in play: supply chain issues, increased costs, the increase in interest rates. Just a lot of variables and factors have affected banks' ability to, not ability, I should say, has affected a bank's risk tolerance. And so, as I mentioned, on real estate, the loan to values in good economic times are at 70% on investment property. Today, what I see more often is 50%. So that gives you an example of what could be considered a credit box shrinking, and businesses and their ability to get financing today. There's lots of variables in that play. Another factor is actually the financial performance for the business. What I've seen in a lot of small businesses over the last 12 to 24 months is, with the influx of the government funds into businesses, which was absolutely fantastic and necessary, it created high cash balances for businesses. And it was during a period of really strong economic activity for most businesses, not all, where revenues were increasing. And so it afforded situations where business owners felt really comfortable adding debt to their balance sheet. And then over time, what I saw was those cash balances were diminishing, but the debt was not diminishing to the same space. And so what I'm seeing as of late is, for businesses that are struggling a bit more, they have less cash on hand, less liquidity. They still have the debt that they incurred over the last 2 to 3 years. And so that's also creating some challenges with being bankable, being able to find financing, qualifying for financing.
Great, thank you so much.
I will add to that point something that I really strive to do, and I learned this probably in the early 2000s. I was working for a national bank at the time, and I was finding that businesses that had been banking with us for 10, 15 years weren't qualifying for credit. And as a junior lender at that time, realizing that I wasn't helping business owners by just saying no. And so I worked really hard at understanding, well, if I can't today, then what? And so as a part of that conversation is helping business owners understand, if I can't approve a loan today, what steps can you take to qualify at a future point in time? And how can we work together to get you to that point, along with if there's alternative financing options. I'll give you an example. I was visiting with a business who had unfortunately shown operating losses for the last 2 years. And so really my ability to be able to approve a loan for them based on operating losses wasn't feasible. And so finding an alternative lender, they happened to be a business that had a high amount of accounts receivable that could be a bridge for them. So factoring is sometimes a solution where they can get cash into their business faster by working with a factoring company that can potentially bridge the gap for them to make the necessary financial changes, operational changes to get them to a point where they have stabilized more and could potentially qualify for a bank loan maybe 2 years from now. That's a pretty common theme that can sometimes come into play. So again, having the conversations and finding solutions and alternative pathways that a business can work on, even if I can't approve a loan today. Any other thoughts, Mara?
I'm good. Do you guys have any other questions? This was really good.
Well, again, I appreciate the opportunity just to shed some
Yeah.
light on investment real estate. Please keep my number and email handy.
Yeah.
If there's ever a question or a situation you encounter, I'm always happy to have a conversation.
Where are you gossip wise? Is it gonna, so we've found residential wise, the election, the outcome truly doesn't matter. For you guys, what are you hearing? Any potential changes, any move depending on November?
Yeah, so really all I've noticed, I mentioned earlier, is kind of a holding pattern. Hold tight,
Yeah.
wait to see. Although, for the most part, it doesn't change anything because we're all here locally doing what we do every day. And although impactful, it's impactful at such a higher level that regardless of how it turns out, we're still going to keep doing what we're doing. We're still going to keep driving business forward, helping our communities continue to be strong in any way that we can. So more of a hold tight, let's wait and
Yeah.
see, and then move on after the day, which I think we're all
Exactly.
waiting for.
Yeah, I agree. Okay, well,
Yeah.
I really appreciate your time. You guys reach out to her, especially if you have clients that are thinking about, I would say just start getting that motion going with her, with Christy to, see where they're at with their loans and what do they need. It could be a process to get everything organized and over to her. I mean, they may need to even create a business plan. A business owner should have that, but if they're starting out, they need guidance. So let Christy help you guys out, okay?
Yeah. Just thank you very much, Mara.
Yeah.
And
Thank
everyone.
you.
Appreciate it.
Yeah. Thank you, everyone. Thank you for your time. Have
Thank
a good
you.
day.
Bye-bye.
You bet. Have a great
Bye.
day.